Stop everything you're doing. Stop scrolling LinkedIn, pretending that motivational post from your CEO about embracing Monday energy is going to change your life. It's not. Close Twitter where you're reading hot takes about whether Bitcoin or gold is better from people who own neither. Nobody cares what they think. Exit that Chrome tab where you've been researching passive income strategies for the past hour while accomplishing zero actual work. That's procrastination with extra steps. Are we clear? Good. And one more extremely critical thing. If you own silver, silver miners, silver ETFs, if you've been holding through 2025's insane rally, do not check your portfolio until you finish this video. Because what I'm about to show you is either going to make you sell at the exact wrong moment after the biggest breakout in modern history, or panic buy at levels that are going exponentially higher in the next 6 months. And I need you to understand the mechanics of what's happening before your lizard brain takes over and makes you do something stupid. Because CNN just published breaking news 7 hours ago that silver crossed $90 per ounce for the first time in human history. And the data behind this move is so violent, so supply constrained, so structurally impossible that every major bank is now forecasting 100 plans silver by mid-2026. This isn't a rally. This is a shortage going parabolic in real time. January 14th, 2026, 7 hours ago. CNN Business published breaking coverage with a headline that should make every investor stop and pay attention. 2026 chaos has set gold and silver ablaze. According to CNN's reporting published today, silver rose more than 6% Wednesday, rising above $90 an ounce, and is up 29% this year. That's a stunning gain, especially considering silver prices surged 141% in 2025 for their best performance since 1979. 141% in 2025. 141. That's not a typo. That's the actual return silver posted last year, making it the best annual performance since 1979. The year gold went from $226 to $524 during the Iranian Revolution and Soviet invasion of Afghanistan. The year that defined what a precious metals mania looks like. And 2025 matched it. But here's what makes the current move absolutely terrifying from a supply perspective. 2025's 141% rally didn't relieve pressure, it accelerated it. Because according to CNBC coverage from 16 hours ago, silver broke above $90 for the first time on Tuesday. That was yesterday. Today, Wednesday, January 14th, silver is trading even higher. According to CNBC reporting from 11 hours ago, it was more than 5.8% higher at $92.03 per ounce by 8:15 a.m. ET on Wednesday. $92, 29% gain in the first 14 days of 2026, after a 141% gain in 2025. That's not price discovery, that's exponential acceleration into a supply crisis that has no resolution. Let me put 29% in 14 days into perspective because I need you to understand the violence of this move. Bitcoin's legendary 2017 rally to $20,000 peaked at roughly 25% gains in 2 weeks during the final parabolic phase. Gold's explosive 1979-1980 run hit 30% in the best 2-week period. Silver just posted 29% in 14 days after already being up 141% the previous year. This isn't early-stage accumulation. This is late-stage panic buying into a known structural shortage. And it's accelerating. According to CNBC's coverage from 6 hours ago, gold and silver are smashing records to start the new year, with gold this week topping $4,600 an ounce for the first time, and silver breaching $90. The two metals have rallied more than 6% and 22%, respectively, just since New Year's. 22% for gold, 29% for silver in 2 weeks, while supply constraints worsen, while mine production stays flat, while China implements export restrictions. While industrial demand from solar, EVs, and AI accelerates, the math doesn't add up. The supply cannot meet demand, and the market is repricing that reality in real time through explosive price action that's forcing mainstream media to cover it as breaking news. But the real story isn't the price. The real story is why silver is moving 4 times faster than gold. According to USA Gold data from January 13th, 2026, the gold-silver ratio has tightened to 52.3, one of the lowest levels in years. 52.3. That means it takes 52.3 ounces of silver to equal 1 ounce of gold. Historically, that ratio averages 70-80. During periods of silver outperformance, it can drop to 40-50. At 52.3, silver is dramatically outperforming gold on a relative basis. And when silver outperforms gold, it signals one thing: industrial demand overwhelming investment demand. Because gold is primarily a monetary asset, silver is dual use. 50% investment, 50% industrial. And when industrial applications create genuine physical shortages, silver explodes relative to gold. That's exactly what's happening. According to the Market Periodical Analysis published 42 minutes ago, the Silver Institute reported a 184 million ounce deficit in 2025. This was the fifth consecutive year with shortages. Mine production has stagnated between 813 and 835 million ounces annually. Demand continues to rise faster than supply. 184 million ounce deficit in 1 year. That's 22% of annual mine production consumed from above-ground inventory for 5 consecutive years, cumulative deficit approaching 900 million ounces over that period. That's more than an entire year of global mine supply gone, vanished into solar panels, EV battery management systems, electronics, jewelry, coins, and bars that aren't coming back to market. Why is this happening? 3 forces creating the perfect storm. Force 1, China export restrictions choking global physical supply. According to CNBC coverage from 16 hours ago, citing Ned Naylor Leyland, investment manager at Jupiter Asset Management, silver is basically disappearing now to China and India. There's about a $10 premium being paid in Shanghai. $10 premium. Silver trading in London at $90. Shanghai paying $100. That's an arbitrage gap so wide it indicates physical shortage in the world's largest manufacturing economy. And it's not temporary. According to Dan Coatsworth, head of markets at AJ Bell, quoted in CNBC coverage from 11 hours ago, supplies are tight and could get even tighter after China imposed export restrictions on the refined version of the precious metal. That matters because China is a net exporter of silver. China was a net exporter, past tense. They implemented controls to secure domestic supply for their solar and EV manufacturing base. Now, refined silver can't leave China easily, and global supply ex-China cannot meet demand. Refineries in Switzerland and London are reporting multi-month delivery delays, premiums are spiking, physical bars are disappearing into vaults, and the price is reflecting that scarcity through vertical moves. Force 2, industrial demand accelerating beyond mine supply capacity. According to Trading Economics analysis from today, steady industrial demand linked to clean energy technologies and artificial intelligence has reinforced the metal's upward momentum. Clean energy. Solar photovoltaic panels require 20 plus grams of silver per panel. According to Silver Institute projections cited in previous market analyses, solar is consuming 200 plus million ounces annually and growing. Electric vehicles require 25-50 grams per vehicle for battery management systems, power inverters, and electrical contacts. Global EV production hit 15 million units in 2025 and is targeting 20 million in 2026. That's 400 to 1,000 metric tons of silver annually just for new EVs. And AI data centers? According to coverage of structural demand trends, every new data center requires massive silver-plated electrical infrastructure for server racks, cooling systems, and power distribution. Microsoft's $100 billion AI build-out, Google's capacity expansion, Amazon Web Services growing. Every data center is a silver sink, and none of these applications can substitute copper or aluminum at scale without performance degradation. Solar efficiency drops without silver paste. EV battery systems fail without silver contacts. Data centers can't compromise on conductivity. The demand is price inelastic and structurally growing. Force 3, geopolitical chaos creating safe haven panic, buying on top of industrial shortage. According to CNN's analysis from 7 hours ago, metals prices leapt higher after the U.S. strikes on Venezuela, and again on Trump's threats against the Iranian regime after a widespread crackdown on protesters. Venezuela strikes, Iran threats, Greenland annexation rhetoric, and most explosively, according to CNBC coverage from 2 days ago, Trump administration threatening to indict Chair Jerome Powell over his comments on a building renovation project, an act Powell called a pretext to gain control over rate cuts Trump seeks. The White House is attacking Federal Reserve independence. Central bank chairs from around the world issued an unprecedented statement defending Powell. The European Central Bank, Bank of England, plus 10 other central banks released a joint statement of full solidarity with the Fed. That has never happened before, ever. When the independence of the world's most powerful central bank is under political attack, investors flee to assets that can't be politicized. Gold, silver, physical assets with no counterparty risk. And when that flight to safety buying combines with an industrial shortage already running 184 million ounce deficits, you don't get gradual price appreciation. You get silver from $70 to $90 in 10 days. Meet Tom Rodriguez. He's a procurement manager for a California-based solar panel manufacturer producing 500,000 panels annually. According to industry sources, companies like Tom's require approximately 10 metric tons of silver paste annually to maintain production. November 2025, Tom's supplier quoted 8-week delivery at $78 per ounce for industrial-grade silver. December 2025, same supplier extended delivery to 12 weeks at $80 per ounce. January 2026, Tom called his rep to secure Q2 allocation. The response, "We're fully allocated through April. We can quote May delivery, but you're looking at spot plus 8% premium. Spot plus 8%. Silver at $90 means Tom pays $97.20 per ounce for delivery in 4 months. If he can get allocation." Tom ran the numbers. His company's silver costs just increased 25% in 6 weeks. That's $2.5 million in additional annual expenses. And he has 3 choices: raise panel prices and lose competitiveness, eat the cost and destroy margins, or reduce production and miss revenue targets. All 3 options are catastrophic, and Tom is not alone. Every solar manufacturer globally faces the same calculation. Every EV producer, every electronics company using silver in components. They're all competing for limited physical supply. They're all bidding against each other, and they're all discovering that supply doesn't respond to price in months or quarters. It takes 7 to 10 years to bring new mines online. Silver isn't stockpiled in warehouses waiting to be purchased. It's locked in central bank vaults, ETF holdings, jewelry that's being worn, and coins that collectors aren't selling. The only available supply is current mine production plus recycling, and that's approximately 1,100 million ounces annually, against demand of 1,184 million ounces in 2025, according to Silver Institute data. 184 million ounce deficit. That deficit doesn't care if price is $70, $90, or $110. The metal physically doesn't exist to satisfy demand. Stop right here. If you're understanding that this isn't silver having a good month, that this is a structural supply crisis going exponential, hit subscribe immediately. Smash that like button like it's your snooze alarm on Monday morning when you're already 15 minutes late. Drop a comment with your country and whether you own any silver exposure, because what I'm showing you next is why even $100 silver is conservative. Now here's where the timeline compresses into pure chaos. Silver doesn't consolidate. According to Fortune's reporting from 10 hours ago covering January 13th prices, at 8:30 a.m. Eastern Time on January 13th, 2026, silver stood at $86.81 per ounce. That marks a $1.93 increase from this time yesterday and more than a $57 rise compared with 1 year ago. $57, year over year. That's a $28.50 starting point in January 2025 to $86.81 on January 13th, 2026. That's the 141% rally CNN reported. But then Tuesday, January 13th, silver broke $90 for the first time. Wednesday, January 14th, it's trading 92 plus, according to multiple sources. That's $5 gain in 36 hours, on top of a 141% rally. That's not consolidation, that's acceleration. And the catalysts keep compounding. Venezuela blockade disrupts oil supply, which impacts industrial production, which creates commodity scarcity. Iran tensions threaten Middle East stability. Fed independence under attack creates monetary policy uncertainty. Every headline creates another wave of safe haven buying, and unlike 2020's COVID panic or 2008's financial crisis where fear spikes then fades, the current geopolitical structure is permanently unstable. Multiple simultaneous conflicts with no resolution pathway. Domestic U.S. political dysfunction attacking institutional independence. These aren't temporary shocks. These are structural regime changes in how global politics and economics operate, and precious metals are the only assets that benefit from permanent instability without requiring faith in any government or institution. But it doesn't stop at geopolitical catalysts, because when industrial buyers realize physical delivery has multi-month delays, they panic, they overorder, they secure allocation at any price. According to Meka's analysis from 16 hours ago, many expect silver to reach $100 by mid-year. $100 by June or July 2026. That's 6 months away. From $92 today to $100 in 6 months is only 9% appreciation. That's conservative if supply stays constrained and geopolitical headlines continue. But here's the cascade. When silver hit $70 in November 2025, procurement managers thought, this is temporary, it'll correct. It didn't. It went to $80, then $85, then $90, then $92. At each level, industrial buyers who waited for corrections got burned. Now they're learning, don't wait, buy immediately. Secure allocation, pay premiums. And when thousands of industrial buyers collectively shift from wait for correction to buy immediately, you don't get 9% gains over 6 months. You get 20% in 2 months. Silver from $92 to $110 by March, $120 by May, and by June you're not talking about $100, you're talking about whether $150 is possible. Meet Priya Chen. She manages precious metals trading for a European hedge fund with $8 billion in AUM. According to institutional mandates, funds like Priya's have historically allocated 1 to 2% to precious metals, split 80% gold, 20% silver. September 2025, Priya's fund had $80 million in gold, $20 million in silver. Total metals allocation, $100 million, or 1.25% of AUM. December 2025, Priya's investment committee met to review 2025 performance. The gold position was up 65%. The silver position was up 141% in 1 year. The committee asked, should we increase silver allocation given outperformance? Priya presented the case. Silver Institute deficit data, 184 million ounces. China export restrictions, choking supply. Industrial demand accelerating. Gold-silver ratio at multi-year lows, suggesting silver has more room to run. But she also noted volatility. Silver can swing 5% daily. Risk management requires position sizing discipline. The committee voted increase total precious metals allocation from 1.25% to 2.5%, but within that, shift from 80-20 gold, silver to 60-40. That means silver allocation goes from $20 million to $100 million, 5 times increase. Priya started executing, bought silver futures, bought mining stocks like Fresnillo and Pan American Silver, bought physical silver bars for vault storage, and Priya knows she's not unique. Every hedge fund, every family office, every institutional allocator who sat out 2025's rally is now rushing in. Not because they think silver is cheap at $90, but because they recognize that at $100, $110, $120, they'll wish they bought at $90. FOMO is the most powerful force in late-stage bull markets, and silver is now triggering institutional FOMO. And here's where the feedback loop becomes unbreakable. Higher silver prices validate the shortage thesis. When silver went from $70 to $80, some analysts said, overextended, needs to correct. It didn't. It went to $90. Now those same analysts are revising forecasts upward. According to CNBC coverage from 16 hours ago, Ned Naylor Leyland from Jupiter Asset Management stated it's absolutely possible for silver to surpass the 100 milestone this year. According to the market periodical published 42 minutes ago, Citigroup analysts forecast that silver will reach $100 per ounce by mid-2026. Citigroup. Not a retail newsletter, not a gold bug blog. Citigroup, one of the largest banks on earth. They're officially forecasting $100 silver by July 2026. And when major banks publish targets like that, institutional clients take notice. Pension funds, sovereign wealth, insurance companies. They see Citi's $100 target. They see silver already at $92. They recognize they have 3 months of potential 9% upside if Citi is right. They allocate. And when institutions allocate, they move billions, not millions, billions. That creates buying pressure that overwhelms available supply, which drives prices higher faster, which validates the forecast, which triggers more institutional buying, round and round, faster and faster, with no natural endpoint except complete inventory depletion or demand destruction through catastrophically high prices. Now let's talk price targets. 3 scenarios. Conservative case, $100 to $110 by mid-2026. This is Citigroup's base case. It assumes industrial demand stays strong, China export restrictions remain in place, and no major geopolitical shocks accelerate safe haven buying beyond current levels. 100 to 110 is virtually guaranteed if the current trajectory continues without major supply relief. And there is no supply relief coming. Mine production takes years to ramp. Recycling is already maxed out. Above-ground inventory is depleted after 5 consecutive years of deficits. $100 is the floor. It's what happens if nothing changes and trends simply continue at current pace. That's 9% to 20% upside from $92 in 6 months. Annualized, that's 18% to 40% returns. From an asset that just rallied 141% last year, that shouldn't be possible. But it is, because the supply simply doesn't exist. Moderate case, $120 to $140 by Q4 2026. This requires modest acceleration beyond Citigroup's base case. It assumes institutional allocation increases from current 1 to 2%, precious metals exposure to 3 to 4% as performance in 2025 and H1 2026 validates the thesis. It assumes industrial buyers forward purchase 6 to 12 months of inventory to hedge against further price increases, which removes 100 to 200 million ounces from the market temporarily. It assumes geopolitical instability continues at current levels without major escalation. 120 to 140 is probable if industrial panic buying kicks in and institutional FOMO accelerates. At $120, silver would be up 30% from current levels. At $140, it's up 52%, after already being up 29% year to date and 141% in 2025. That's the scenario where the feedback loop fully activates, where Tom Rodriguez and every other procurement manager decides they can't afford to wait any longer, where Priya Chen and every other institutional allocator decides 2.5% isn't enough and they need 4 to 5%, where retail investors who missed the entire rally finally capitulate and buy at any price. Aggressive case, $150 to 200 plus by late 2026 or early 2027. This is the parabolic scenario. It requires a catalyst. Catalyst 1, a major mine disruption. Mexico supplies 23% of global silver. Peru supplies 18%. A political crisis, labor strike, mine accident, or environmental disaster in either country removes 200 plus million ounces of annual supply overnight, against a market already in a 184 million ounce deficit. That creates genuine physical shortage where industrial buyers literally cannot source metal at any price. In that scenario, price doesn't move linearly. It gaps. 70 to 90 in days, 90 to 120 in a week, 120 to 150 in another week. Catalyst 2. China escalates export restrictions to a full ban on refined silver exports. If Beijing decides silver is critical to domestic industrial capacity and prohibits any exports, global ex-China supply drops by 30-40%. That's catastrophic for Western manufacturers. It forces European and American companies to compete for limited refinery output in London and Switzerland. Bidding wars ensue. Premiums explode. Prices follow. Catalyst 3. A geopolitical event that triggers simultaneous safe haven buying and supply chain disruption. A Middle East conflict that closes shipping lanes. A U.S.-China confrontation over Taiwan. A domestic U.S. constitutional crisis around Fed independence. Any event that makes holding paper assets feel riskier than holding physical metal while simultaneously disrupting commodity supply chains. In that scenario, silver doesn't just go to $150, it goes to $200, maybe higher. Because at that point, it's not about supply and demand fundamentals. It's about fear, and fear has no price ceiling. Some people will argue silver is too high here, that 29% in 14 days is unsustainable, that it needs to correct before going higher. And technically, they might be right. Silver could pull back 10-15% to $78, $80 before the next leg up. But here's what they're missing. Every correction in this bull market has been brief and shallow. Silver went from $65 in October to $58 in November. 3 weeks later, it was back to $70. Then $80 by December. Then $90 by January 13th. Then $90 by January 14th. The corrections lasted days, not weeks, and they were fully retraced in shorter time frames. That's the behavior of a market in structural shortage. Dips get bought immediately because industrial buyers need the metal and can't afford to wait for deeper corrections that never come. According to CNBC coverage from 11 hours ago, while gold and silver are close to all-time highs, there does not appear to be any catalyst in the near term that is likely to cause prices to drop. No catalyst for drops, multiple catalysts for continued gains, that's the setup. And when you combine that with Citigroup's $100 target, Jupiter Asset Management's 100+ forecast, and the structural deficit data, the risk-reward favors being long, not waiting for corrections. Here's what happens next. January 2026, silver consolidates between $88.95 as the market digests the breakout above $90. Industrial buyers place Q2 and Q3 orders. Premiums stay elevated at 5 to 10% above spot. Physical delivery delays extend to 4 to 6 months. Mining stocks like Fresnillo, Pan American Silver, and First Majestic continue rallying as investors recognize operating leverage to higher silver prices. February-March 2026. Institutional allocation increases. Priya Chen's fund is at 2.5% precious metals. By March, they're at 3.5%. Other funds follow. Hedge funds, family offices, pensions, all adding 1 to 2% exposure. That's tens of billions of dollars competing for limited ETF shares and physical bars. Silver tests $100, breaks through, media coverage intensifies. Retail FOMO begins. April-May 2026. Tom Rodriguez and every other industrial buyer realizes corrections aren't coming. They forward purchase aggressively to hedge against 120 plus silver. That removes another 100 million ounces from available supply. Silver pushes $110, then $120. Citigroup's $100 target gets hit by April, 2 months early. They revise to $120 by year-end. June-July 2026. If no major catalyst hits, silver consolidates at 115, 125. If catalyst hits, silver explodes to $140, $150. In 2027, that's when the shortage becomes undeniable. That's when mine supply still hasn't increased. That's when cumulative 6-year deficit exceeds 1 billion ounces. That's when industrial buyers start rationing usage or shutting down production lines. That's when silver becomes a headline story every single day. Meet Yuki Tanaka. She runs a small electronics manufacturing firm in Osaka, producing circuit boards for automotive suppliers. According to industry data, companies like Yuki's use 500, 800 ounces of silver annually in their production processes. November 2025, Yuki's silver costs were $39,000 annually at 78 HAO OZ for 500 ounces. January 2026, at 92 Oz, her costs are now $46,000. That's 18% increase in 6 weeks. For a small firm with tight margins, that's devastating. Yuki called her supplier. Can we lock in pricing for 2026? Response, no price locks beyond 90 days given market volatility. Yuki asked about switching to silver-plated copper to reduce costs. Engineer's assessment, possible for some applications but requires 6 months of testing and retooling, and performance will degrade 10-15%. Yuki is trapped. She can't substitute quickly. She can't lock prices. She can't pass costs to customers because her contracts are fixed. Her only option, buy forward and hope silver stabilizes. She placed an order for 1,000 ounces, double her annual usage, for $92,000. At $92 Oz, locking in current prices before they go higher. And she knows if silver hits $120, she saved her company. If silver corrects to $70, she overpaid by $22,000, but still has the metal she needs. Risk-reward favors buying now. And when thousands of small manufacturers make the same decision, that's when 100 million ounces disappear from the market in weeks. And here's the mathematical trap. Silver's above-ground inventory available for sale is approximately 1.2 billion ounces. Sounds like a lot, but that includes central bank reserves, not for sale, ETF holdings, not for sale unless investors liquidate, jewelry being worn, not for sale, coins held by collectors, not for sale, and industrial stockpiles, minimal due to just-in-time inventory. Actual available supply is annual mine production, 835 MAZ, plus recycling, 250, 300 MAZ, factored roughly 1.1 billion ounces, against total demand in 2025 of 1.284 billion ounces, according to Silver Institute calculations. 184 million ounce deficit. If demand stays flat in 2026, deficit continues. If industrial buyers forward purchase like Yuki, demand spikes 20-30% temporarily. That creates 450 million ounce deficit in 2026. At that deficit level, you don't get 9% price gains. You get 100% price explosions because the metal physically doesn't exist. And when buyers realize that, they panic. They bid whatever it takes. They secure allocation at any cost, because losing production capacity due to metal shortage is more expensive than paying $150 AUD for silver.